Okay, good evening, everybody. We're at the halfway point of our class. Congratulations. Here's the good news and the bad news. The good news is we're at the halfway point of our class. The bad news is we have a lot of work left. 3 cases, a capital budgeting case, 4 major pieces of work to remain in our class. One of them is case number 2, posted this week. We will talk about that a little bit later in our class. Case number 2 will be posted to Blackboard to the case study file folder around 6:30 this evening. And it is going to be a case that you will do in a PowerPoint format. PowerPoint. That will be the format of this case, and I'll explain all the details. I've given examples and samples in Blackboard. I've provided videos for any of you are first-time learners of PowerPoint, but you will do this in a PowerPoint presentation. You don't have to worry about presenting it to class, but you have to worry about doing this casework in PowerPoint format. And we'll talk more about that later. Our main topic tonight, which we're going to be spending this week and next week on, is capital budgeting. Determining whether an asset's returns make enough return to qualify as a legitimate investment. Capital budgeting. Many of you have studied somewhat of this in your 500D class, if you've taken it before this class. Many of you have studied it in other aspects of your academic experience. And maybe some of you have totally forgot about this or totally don't even care about this. All right. Well, I'm going to make you care over the next 2 weeks. This, of any financial operation, this is huge. To being able to decide whether the investment in a capital asset is going to provide you the necessary return to feed back or pay back your investors and give you a return in the future to reinvest in the company in additional projects and or assets. This is chapters 10 and 11. I'd like to now go to our Blackboard and show you a couple files that you should be able to download tonight and follow along with me. If you do not want to download them, I will post them back to Blackboard as completed files at the end of this evening. But this file is your template for case number 3 and the capital budgeting case that I assign to you next week. This is your template for those bits of work. Next week, I give you a capital budget case. It's called the Electrics Incorporated. This case is given to you next week, and it is due the last week of class. You have basically 4 weeks to do it. It is a capital budget analysis and a paper to explain the analysis. Case number 3, which we have in a couple of weeks, is on this same subject. It's kind of like practice. It's kind of like making sure you understand it as you're doing the electrics case. Case number 2 that you have tonight has nothing to do with capital budgeting. It has everything to do with our topics of the last 2 weeks in our class. So we'll talk all about that in detail as we move forward. So let me show you this special file. If I bring up our Blackboard account, here's our Blackboard account. First of all your grades have been posted for your discussion post of this past week, and I want to thank you. And I'm not saying this to blow smoke up here, you know what. I'm saying this honestly. Those were very well presented information and writings on that discussion forum for last week. I was very impressed by your thoughts, your honesty, your interpretations. Thank you. And those grades have been posted to Blackboard and are now now a part of your grade average in our class. This week, we have 15% more being added to that grade in case number 2. At the end of this week, we will have 40% of our grade covered through week number 5. That means 60% of your grade is yet to be determined in the final 4 weeks of our class. So a lot of work coming up, but we take it in stages. We take our time to make sure we understand it, and we move forward. If I go to week number 5 tonight, which is this week in your Blackboard, you will see the introduction video that I did for you yesterday, kind of getting prepared for this week. And also you will see in week 5 in-class capital budget review. This is the file that I'm going to be working on tonight to begin our discussion of capital budgeting. This week, we're going to talk about capital budgeting. Next week, we're going to talk about the risk analysis of capital budgeting, scenario and sensitivity analysis, which is in chapter 11. Tonight, we're going to be mainly talking about chapter 10 and the cash flow part of chapter 11. So if you can download this week 5 capital budgeting review spring 2020 file to your laptop or to your desktop, and follow along with me tonight, that'll be wonderful. If not, if you do not have the capability of doing that, I will again do the work on this file tonight and then repost it at the end of our class back to Blackboard. Again, this template or this spreadsheet has nothing to do with case number 2. It has everything to do with your capital budgeting case of next week and case number 3. So if you download that, you can follow along with me in our class. And this is what that case or that spreadsheet looks like. It begins with an overlook of the capital budgeting process. Basically the process and the steps that we use to determine whether a return in asset is viable, okay? For example, I work for Disneyland, or Disney, Disneyland. I work for Disney and I'm thinking about opening up a new park in Buenos Aires. How much is the investment going to take to invest and create a theme park in Buenos Aires? Let's say $1 billion, all right? Is that $1 billion going to give us enough return to warrant the investment of $1 billion? Before any checks are cashed, before any architectural or strategy sessions are done, we have to determine, is this investment of $1 billion feasible? And the determining of that investment is the cash flow that's going to be generated by that investment, discounted over time at our cost of capital. And we began that discussion last week of chapter 9, the cost of capital. So this is the steps we're going to be doing tonight and next week. Determining how much we're going to be investing today. What is the depreciable life of that asset? Because that's what the accountants tell us, how long the asset is going to have a financial life, the depreciable life. We're going to determine the net income off the project, revenues minus expenses. We're going to determine the net cash flow of the project, taking net income and adding back in depreciation, taking into account working capital and the disposal of this or the salvage value in the final year. Then we're going to do a return analysis, net present value, internal rate of return, profitability index, and payback. These are all in chapter 10. And then we're going to do it, and this is what we're going to do next week, we're going to do a risk analysis of this information. Does it make sense and does it match what we think is going to happen? A scenario and sensitivity analysis. There's videos in week 5 that describe this process. There's videos in the YouTube playlist of our class that describe this process. But probably the best description of this process will be in our class discussion and how we do this in class. That's why I am recording this class this evening, and you can play it back at your convenience when it comes time to doing this capital budgeting work. But let me stress again, the role of a CFO, the role of a finance person in a corporation is to what? maximize the return and value of the company. And how do you maximize the return and the value of the company? You invest in assets at the cheapest possible cost that can provide the greatest return over time. I'll say that again. The CFO of any corporation, the financial manager of any corporation, of any mom and pop business, of the University of Laverne, of the federal government, whatever. Their job is to maximize the value off the investment in the assets at a cost, a cheap cost of acquiring that capital to invest in the asset, and then that the asset provides an adequate return on its investment over the life, the depreciable life of that asset. And to calculate that return over time, you determine the cash flow, which is points 3 and 4 of this little list that I have here. Determining the net income and determining depreciation, working capital, and the disposal of the asset over time. Now, for some of you, this is old information. You've done this before. In Business 500D, you probably did a paper and a project on this. It might have been called Tesla. It might have been called Best Trucks. It could have been called Road Kings. Some of you have already done this analysis in prior classes. Others of you have not done this yet. Well, you're going to do it now, because to be a financial manager with an MBA degree, you got to be able to understand and put this together and understand what it tells you as far as strategic decision making before you even actually start the project. Every company in the world does this. University of Laverne does this. The federal government, with some shortcuts, does this. And this is a key to studying finance at our level. What does it take to get the data to make the strategic decisions for the future? So we're going to begin with this template, with this file this evening. If you look at the next tab, I review what we talked about last week, determining the weighted average cost of capital, the cost of money for this company. We'll review this. This is what we talked about last week. The number here is 8.83%. That's our cost of our money. And then we'll look at this base analysis, and we'll put this spreadsheet together. It's called a base analysis with these variety of inputs that we will need to do and place in this analysis and determine the cash flow and the return analysis. This is chapters 10. So this is what we're going to do tonight. We're going to put this together. You're going to have to do this in your Electrics Incorporated capital budgeting case that I give you next week. And you're going to have to do this in case number 3 in 2 weeks. This will be your template. This will be your learning tool to study this. That template is in your Blackboard tonight. Follow along with me if you can. If you cannot, download this at the end of class and study it, study it, study it. Understand how it works. What does it tell you? That'll be the key to you being able to write and explain this in future discussions. Okay, well, let's go back to our beginning. As we said, the capital budgeting process is a series of steps to determine the return of an investment in an asset. All right? I don't care if the asset is a telephone system, a computing network, a series of desktop computers, a building, land, a product, whatever. You're trying to determine, is that asset going to give you the greatest return possible based on the inputs and the parameters of that specific project. Your job as a finance person is to be able to work with an organization that provides you with the base inputs that you can make this decision. That's why you talk with the accounting people, the production people, the marketing people, the sales people. They will provide all the inputs, and you put this all together and put together an analysis like this so you can make the strategic decision. And it requires some knowledge of accounting. What's a variable cost? What's a fixed cost? Remember those days of accounting. It brings a tear to my eye when I think about variable cost, fixed cost, working capital. Those were the days when life was much simpler in accounting. But now we're at the MBA level of finance, and we have to put all these pieces of information in to tell us something about a decision. What's the decision? We're investing $1 million. We're investing $1 million today. And is that $1 million going to provide us with an adequate return on our investment over time? That's what we're doing. And that's what this analysis is all about. And this template has calculations and totals already into it. And as we build this template, you'll see it develop into an overall capital budgeting analysis. But first, what is our cost of money? If we're going to spend $1 million on an investment, where is it going to come from? Are we going to borrow it? Is it going to be, are we going to issue some stock or equity? Are we going to take it out of our profits from prior periods? Where is the money going to come from to fund this $1 million investment? Well, we make some certain assumptions to determine that. We want to assume that we want to maintain the capital structure of our company. We don't want to change the capital structure of our company. Because when we change the capital structure, the share of the return, the share of the cost changes. So the first assumption is we're going to maintain a debt to assets relationship of 60%. If we maintain that debt to assets representation of 60%, that's going to drive our costs of debt and our cost of equity. That will produce our cost of capital, the weighted average cost of capital. We discussed this last week. So the first assumption is we're not going to change much. I'm going to give you a little sneak peek. In case number 2 tonight, you're going to be doing a strategic analysis of a financial statement of a company, and you're going to tell me, what if we change the capital structure of this company? How is that going to affect the return on equity, the profits of the business? That's a question in case number 2 tonight, and we'll look at that a little bit later, probably after a couple glasses of wine. Then we'll tackle that one. All right. So we're going to maintain the same capital structure, 60% debt, 40% equity. The company's tax rate is 30%, and their current interest rate on their debt is costing them 9%. Well, based on that, my after-tax cost of debt is the 9% times 1 minus the tax rate. That's our tax shield, as they say in the business. So 70% of 9% is 6.3%. That's my after-tax cost of debt. We talked about this last week. We're taking the interest rate on the debt times 1 minus the tax rate. And then we put that 6.3% down here and weight it by the 60% of our capital structure in debt, and we get the average, weighted average cost of debt as being 3.78%. Our cost of equity, we've done this a few times already. It's our capital asset pricing model. What does the market, based on the risk in the market, indicate to us? What should be our investors' return on equity? Our investors' return on equity is the money we would ask for our investment from shareholders in the form of issuing stock, but also the money we would take from shareholders by using our retained earnings, our profits, and taking that away from them and using it as an investment vehicle. We have to pay the investors back for using that equity. That's their money. What is the cost of that equity? Well, in the market, in this example, the risk-free rate is 2.5%. Oh, I wish for those days. The market return average of the overall stock market, usually the S&P 500, is 10%. And this firm's specific beta level, their specific risk, is 1.35. We saw last week when you, in case number one, when you choose those variety of different companies that each one of you did, each one of those companies had a different risk level, a different beta. And that determined how much their expected return on equity is in the marketplace. So we use our capital asset pricing model. We take the risk-free rate plus the market return minus the risk-free rate and multiply that times the specific beta of our company, 1.35. We do that arithmetic, we get 12.63 as our cost of equity, our expected return to our investors if we use their money to fund our project. And how much of the project they're going to fund? 40%. That's our current capital structure of equity in our organization. So we take 12.63% and weight it by the percent of capital structure. We get 5.05%. So taking a look at the overall company funded by 60% debt and 40% equity, our cost of money is 8.83%. That's our weighted average cost of capital. That's our hurdle rate. That's our opportunity cost. However you want to say it, that's the cost of the cash. So to go out and get $1 million to invest in a new asset, and we want to maintain the same capital structure of our company as of now, 60% debt, 40% equity. In the market for debt, we're paying 9%. After tax, it's 6.3. In the current market for equity, with our risk and the risk-free rate and the market return rate, it's costing us 12.63%. The combination of the two, weighted to the capital structure, is 8.83%. And notice what I do with that 8.83%. I now place that as an input, there it is right there, an input in our analysis of capital budgeting. It's now going to be our cost of money when we determine our return analysis. That's our cost of money. So I'm going to stop right there. I'm going to have a drink of iced tea. I think it's iced tea. Damn, it is iced tea. Okay, so I'm going to take that. And then I'm going to ask this, oh, we have a chat question. Let's see what our chat question is all about here. Long Island iced tea, very good. I wish. If I had a Long Island iced tea, I think I haven't had any alcohol in about 4 weeks. If I have a Long Island iced tea tonight, I'd fall on my butt. I'd be in big trouble. So I have to behave myself. So I'm kind of like non-drinking alcohol during the quarantine period. It's not working out. Okay. So as I said, does anybody have any other questions about, first of all, this little schedule and the cost of capital calculation that we looked at last week? Any questions? Okay. Now let's tackle this. All right. It looks menacing, but it's really not that difficult. It's common sense. It really is. The only menacing part of this, I would guess, would be the working capital calculation and probably doing these analysis. Now, before I get into start crunching numbers, let me talk about a couple things that you can relate to in the textbook. Even though my explanation is the best, there are parts of the textbook that you can refer to this process. Remember, at the end of this process, once we calculate all these cash flows going out, we're going to do what is this called? A return analysis. Net present value is on page 417 of your textbook. Internal rate of return is on page 419 of your textbook. Profitability index is on page 429 of your textbook. And the payback in years is on page 430 in your textbook. Those are the explanations. These are different ways of determining return. Net present value is in dollars. Internal rate of return is in percent. Profitability index is in a ratio. The payback is in years of returning your investment. We'll go through this again, but that we're looking at these same numbers in different ways. Dollars, percent, ratio, years. And those talked about in chapter 10. Now remember, back to my original diagram here, I said that the capital asset pricing, the capital budgeting process is based on asset investment. Well, what's our asset investment? $1 million. The equipment cost. Let's say we're investing in a piece of equipment. And notice I'm making that investment today, year zero. That's today. So $1 million negative is how much cash I am spending today to purchase the asset. That's my investment cost. Then I go to my accounting people and I say, okay, guys and gals, what is the depreciable life of this asset? What do our depreciation tables, what does the IRS say? How long can we depreciate this asset? Well, in this particular case, the depreciable life is 10 years. 10 years, that's the depreciable life. We might own this investment for 30 years. But financially speaking, it only has a life of 10 years. Why? Because that's the depreciable life. By depreciating it every year over 10 years, we're creating cash flow. Depreciation is an expense, but it's a non-cash expense. We're generating return off just depreciating it. A lot of you people probably don't remember, but back in 1979, the circumstances of our economy were fairly similar today, but except for the cost of inflation. In 1979, Jimmy Carter was the president. He was in his 4th year of office, and the economy was in the tubes. Inflation was 15 and 16%. The unemployment rate was 10%. The cost of oil was huge. The world was out of control. The Iranian hostage crisis, we weren't going to the Olympics. Everything was nuts. Nobody knew what the hell was going on. Very similar to the atmosphere in our country today. So Jimmy Carter got kicked out of office. Sorry, Jimmy, it's not working. And guess who became president? Ronald Reagan. Well, and Ronald Reagan said, I'm going to change things. Now, Ronald Reagan was an actor. He wasn't an economist. But the best thing about Ronald Reagan, now let me just say I was not a major Ronald Reagan fan, but at the same time, Ronald Reagan knew how to hire the right people. In the first week on the job, he did one thing that gave the economy a kick in the pants. And what was that? He changed the depreciation tables for the IRS. He made it faster to depreciate assets. By doing that, it created additional cash flow for the companies, and also it gave a stimulus for companies to purchase again these assets. If they depreciate faster, at the end of their depreciable life, you have to go out and buy another asset. It gave the economy a kick in the you-know-what. Today, Donald Trump is trying to do that by keeping interest rates cheap, by making our products be purchased and bought within the United States. That's his way of trying to get the economy going again now that we're in the coronavirus recession. Is he going to be successful? Depends on who you ask. But Ronald Reagan, to change the economy back in 1980, changed the depreciation schedules of a company. So if I'm depreciating this over 10 years, all right, excuse me, if I'm depreciating this over 10 years, that means I'm going to depreciate $100,000 a year. All right, I'm going to depreciate $100,000 a year. That's $1 million depreciation. All right, I'm going to write off that investment over 10 years at $100,000 a year. Notice what happened to our template when I put in that number. It recorded depreciation as an operating expense of the project, and at the same time, it added it back down here as cash flow after net income. It added it back because depreciation is a non-cash expense. We're allowed to expense it, but we're not writing a check to Mr. or Mrs. Depreciation. So we add it back because it's cash flow. We didn't spend it. So we're adding it back. That's depreciation. At the same time, let me just check these off as I go through them. Then they tell us in the next line, the salvage value is $50,000 at the end of the life of the project. So notice I have a line here, salvage value. So in year 10, I'm going to put in $50,000. That's the salvage value of the investment at the end of its life. We're going to fully depreciate it at $100,000 a year for 10 years, and then we're going to dispose of it. Maybe, maybe not, but we're planning on that. We're going to dispose of it of $50,000 in year 10. And notice I have it here, but I'm missing one important concept. Are there any accountants in our audience? What do you do when an asset has been fully depreciated, like this one here, and you get $50,000 cash at the end of its life for disposal? What must be accounted for? Anybody? Nice whistle. This has tax implication. Very good, Mr. James. It has tax implication. So in other words, I have fully depreciated it over 10 years down to a value of 0. Then in the 10th year, I'm disposing it for $50,000. I have to pay a capital gains tax. So that $50,000 is going to be multiplied times 1 minus the tax rate, which is 30%. And I get $35,000 in year 10 of additional cash flow. I have to pay tax of 30% on that $50,000 as a capital gain in that final year. So I'm accounting for that cash or that tax by taking it out of the disposal value of $50,000. I have to pay 30%. 30% of $50,000 is $15,000. So I'm going to net out $35,000 in year 10. Now, probably some of you are saying, who gives an RA about this? Well, remember, you're taking into all the accounts of what this investment is going to return to you over its life, in this case of 10 years. We're depreciating it, and then we're selling it, dumping it for scrap, for whatever, at the end of its life. Because we fully depreciated, it's a capital gain. We have to pay our share of taxes. All right? All right, that's done. People do this for a living and get paid an awfully lot of money. Trust me. All right. The next input. So I go to my salespeople, I go to my marketing people, I go to my production people, and I say, dudes, how many of these units that this investment is going to create, how many products this investment is going to create, are we going to sell every year? What do you guys think we're going to sell? How many do you think we're going to sell? Well, the marketing people get with the salespeople and they say, well, in our market right now, if we sell this product at $20 a unit, we can sell 25,000 units a year. At the same time, our production people and our manufacturing people will say, We can do that. I think we can make 25,000 of these units a year. So it's decided that in the market today, our marketing and sales people say we can make and produce 25,000. And our salespeople say we can sell those for 20 bucks a unit. And our manufacturing people say, yeah, that'll work. So how much revenue are we going to create? Well, all we have to do is in the year one, we put in equals the number of units sold, which that column or that factor is column B, cell B8, and we multiply that times the selling price of the unit, $20. And so remember, I do put this in year one. Why don't I put it in year 0? Because that's today. Year 1 is at the end of the first year of operations. We don't put it in year 0, but that's today. We haven't done anything yet. So if I put in that arithmetic, it comes out to $500,000. But look what happened. If you notice the next line, it says the sales price will inflate at 2.5% a year. We're going to sell 25,000 units every year, but the selling price is going to go up with inflation every year by 2.5%. And notice in every cell, I take the number and multiply it times 1.025. That's increasing it by 2.5% every year. So over the course of 10 years, I'm selling a total of $506,000 of sales. If I sell 25,000 units a year at 20 bucks a pop, and that $20 is inflating every year at 2.5%, which makes sense. Our costs go up, inflation goes up. We got to stay competitive with that. There we go. So now I have just determined my revenue line.
Professor, can you go over that one more time about the 2.5% and you got 1.025?
Yes. What's 100% in decimal? 1.00. What's 2.5% in decimal? 0.025. So if I'm going to increase it every year, I add 2.5% to 100. That's my inflation rate, 1.025. Make sense? When I took this class in this screwed me up too. I go, Professor, what are you doing? What is that 1.025? What the hell's that all about? It's the inflation added every year. You add it to 1. And that's how I did it. If you take 2.5% of 500, that's 12,500. You take 2.5% of 5,1205, it's 25,313, and so on. That's that calculation. Okay, Yvonne, make sense? Thank you. Okay. So I've just determined my selling price, and I just determined my inflation rate for my revenue. Notice I'm just putting in the pieces of a puzzle. All right, I'm going to save this. Oh, word to the wise. If you're working on a problem and you're having to do this, always save it now and then. I can't tell you how many times I had to go to 1-800-FINANCE-HELP and talk somebody down from a suicide attempt because they lost all their work because they didn't save it. Make sure you save your work at different intervals during this process, because imagine putting together all this and at the end you do something to click on the computer, or you have a power failure, or your kid comes by and hits the keyboard, and next thing you know it's all gone and you go, what? Make sure you save it after every attempt.
Okay, Professor?
Yes.
Somehow I've done everything you've asked, but my numbers at the net cash flow are off.
Well, we haven't. There are numbers down here like at net cash flow, like down here, 378. Is that what you mean? Well, remember, if you take 400,000 less the tax, that's 280,000, plus 100,000 minus 1,500, you should get 378.5. You might want to check your formulas there if they match my formula. It's the same file, so the cell numbers should be correct. And I'll get to this later on. So you're taking profit plus depreciation minus working capital equals net cash. F16 plus F19 plus F20. F16 plus F19 plus F19 plus F20. Do you get 378.5? Tell me what you get, Yvonne.
181.5.
181.5. So you have 500,000 of sales. You have 100,000 of depreciation. So you take 500,000 and you subtract out depreciation. That's 400,000. Do you have 400,000 there? Do you have anything in these cells? So your cell in F13 should be F7 minus F10 minus F11 minus F12. The only thing that's up there now is F12. 500,000 minus 100,000 should be 400,000. Check your formula. Is it right now? Are you putting a depreciation as a negative 100,000? You put it in as a positive 100,000. Because it's subtracting it in the formula. Put depreciation in as positive $100,000. Then you should get 400,000. Do you? Now do you get 378.5? Are you taking 30% of 400,000 here and subtracting it from the 400,000? You got it. Okay. There we go.
Hey, Professor.
Yes, Jesse.
Move on. Just one quick thing. Is there any way we can add a note to the formula line without it affecting the actual formula? Like just a quick note as to. So
yes. For example, if I want to say here, I'm in this cell here, I can right click and say, where to go? New note. See that here? It says, go back here. You click on a cell, you right click your mouse, and down here under the menu it says new note. And you can say, oh, 2.5% inflation. You can write a note to yourself. And then you'll see a little red mark there, and you put the mouse on the cell and it gives you a reminder of what happened in that cell. Does that make sense? Cool. Now, if you want to get rid of that, you just right click and say delete note, and it's bye-bye. But you can make little notes to yourself by right clicking your mouse and saying new note, and you can make little notes to yourself about what's going on there. It's a good tip. Good question. Good question. All right, where was I? Hold it, I need more iced tea. This class is going to be either exciting for some of you or very, very long and boring. Why? Because if you're not working on this spreadsheet like I am as I'm going through it and just staring at it, it's not going to be too exciting of a class. But what can we do? All right. Oh, I got a chat question. Can you explain why you made the investment negative? Well, you made the investment negative because I'm dispersing cash of $1 million. I'm spending $1 million of cash, all right? Now, yes, I'm spending cash here in depreciation, but I include that in my formula as a minus there. Here, I want to determine my net cash flow in year 0. Well, it's going to be negative because I'm purchasing the asset, and I'll get to this working capital line in just a minute. But that's my investment. I'm spending $1 million of cash today. Okay, James, got it? Thumbs up? Okay. So where were we? Okay, now we go to our production people, are people who actually produce the product and say, okay, dudes, what is it going to cost us to build the sucker? The selling to people tell us we can sell it for $20 a unit, and that's going to inflate every year at 2.5%. But at the same time, what is it going to cost us to build the product that this equipment is producing? Well, we break that down by variable and fixed cost. Remember I said earlier, think back to managerial accounting, financial accounting. There's two different ways of showing costs, expenses. What makes up variable costs? Costs that change with volume but stay the same per unit. That's a variable cost. Wages, materials, overhead, advertising, whatever. And this company says it's going to cost us in year one $8 a unit in variable cost. Okay? Many of you, as a prerequisite for this class, had to take Accounting 203 or 500A. In that class, you should have studied fixed and variable costs. And look at Jesse now. He's now drinking a full beer in one swallow. He can't take this anymore. Oh, it's not a beer. Sorry. All right. So that it's going to cost us $8 a unit in variable costs. So now, and remember, that's going to inflate at 2% a year, not 2.5%. Mr. Hassey's making this as complicated as possible, but 2% a year. So in year one, I take equals the number of units we're producing, 25,000, and I'm going to multiply that star times the $8 a unit variable cost. And I get $200,000. And look what happens. It inflates every year now at 2% every year, 1.02. So you should have a total of $2,189,000 of variable cost expense for this project. The $8 a unit times the number of units you're producing every year and selling, and inflating after year one at 2% a year. And notice how our numbers change, Yvonne. Ooh. All right, getting a little bit dramatic here. So that's our variable costs. But then we also have fixed costs. What are fixed costs? Fixed costs are costs that you have every year that are not influenced by output. Wages, materials, labor overhead, advertising, those are influenced by the more you produced, the more you have cost. But fixed costs are there if you produce 1 unit or 25,000 units. Fixed costs, costs that never change. In regards to volume, they do change with inflation, naturally, but they don't change in relationship to volume. And notice they tell us in this project that our fixed costs are $50,000 a year. And that's going to be inflated at 1% a year in this analysis. So I put in year one equals the cell that 50,000 are in, that's B13. I hit return, and now it inflates after year one at 1% a year. See, if you set this up accordingly, it makes it very simple to fill this out. You should have roughly around $523,111 of fixed costs. Well, ladies and gentlemen,
Mr. Hassey?
Madam, and question, James.
So under variable cost, I'm getting a different number than 200 in year one. So I'm multiplying $8 times $8 of variable cost times $20 of the sales price in year one. Is that right?
No, $20 is what we're selling it for. How many units are we producing in year one?
25.
So it's
25,000.
$8 times 25,000.
Oh, okay. Okay.
Okay.
Got it.
Put that in there and you're all set. James, where are you? What's the background there? Give us some info.
Oh, that's St. Petersburg, Florida, my hometown.
You're from St. Petersburg.
Yes, sir.
So are you a Tampa Bay Buccaneer fan?
Yeah, I was once in a while. Once in a
Well, I would think you would
one
be
time.
now. I think would think you would be
It's
now
getting
with
better. Yeah.
with Tom Brady. Yes.
Yeah.
Are
And
you-
Gronk.
Gronk's over the hill. Forget it. He's going to have one hit and he'll be finished. Trust me. All right. I have a chat. Let's see what the chat is. Angel, we haven't heard from you tonight. Lovely. Good to hear from you, Angel. Angel said, would you go back over the FC part? I'll be happy to, Angel. I hope you're well this evening.
I am, thank you.
Okay. The fixed costs are $50,000 a year. And they're going to inflate at 1% a year. Remember, fixed costs are the same every year. They don't change in relationship to volume. So $50,000 is going to be, I'm not like in here for variable costs that James just asked, I'm taking $8 times the number of units, $25. Here, it's just a flat $50,000. I'm not multiplying that times nothing. And then I'm inflating it by 1.01, which is 1% every year. Fixed cost, variable cost. Variable cost is taking the cost times the volume. Fixed cost is just a flat amount, 50,000, increasing by the 1% every year. Okay, Angel? Oh. Angel has it. You know, Angel, you can turn on your microphone and just say, I got it, but that's all right.
All right, I will next time.
Okay.
See, I have this little dog that barks every time I come off the mute. So
What's the dog's name? What's this dog's name?
that's Peter.
Can't you lock Peter in the bathroom during this class?
Oh, did you hear that? He didn't like that.
Oh. Well, my wife locks me in the bathroom when she's got friends over. She locks me in the bathroom. I don't see what the difference is.
Hey, I told the class last night that if you just keep yourself muted, but you hit the space bar on your laptop, that temporarily unmutes you. So that might be easier.
Yvonne is becoming a Zoom expert. Impressive. That is impressive. Hitting the space bar will naturally unmute you. Wow, Yvonne, you are becoming a Zoom Kool-Aid. That's what they call them. All right. Tell that to Disney. You might get a pay raise out of that. All right. Or at least keep your job. All right, here we go. So now look what we've done. We've now completed our income statement. We've done an income statement. Sales or revenues minus expenses equals earnings before taxes. Take 30% out of those earnings, and we have our net income. There it is right there. We've just done an accounting income statement. A little basic, but it's an income statement. We're making $1.3 million a year in profit. But the key word there is profit, not cash flow. The key word there is profit, not cash flow. How much cash are we generating off this investment? And that's when we get into this area down here. All right. So first of all, let me wipe out these costs that we've already done. We just did taxes, so that's out. We don't have too many left. All we have is working capital. This is easy, isn't it? How am I going to remember all this stuff? I will never know, but that's all right. You just build on it. We practice it a couple of times. All will be well. We're going to practice. We're going to do another problem next week. All right, next week we're going to do another problem. Matter of fact, I'll be sending that to you on Friday. I'm going to be saying, all right, guys, I assume now you're done with case number 2. Here's a practice problem on doing this spreadsheet, and bring it to class next Monday night, and let's see how you do. So I'm going to do that for you next Friday, so you can you don't have to do it. It's not for a grade, but we'll talk more about that later. All right, now, notice what I'm doing here. I've determined net income. Let's highlight that. There's my profit. But I'm not near done yet, because what am I trying to do in a capital budget analysis? Let's go back to this little chart. I'm trying to determine net cash flow, which net income is a part of, but I'm trying to determine how much cash flow am I generating. And that's this next step here, okay? we have depreciation as an expense. In variable costs, we're paying people. We're writing checks for wages, materials, advertising, vendors. We're writing checks. For fixed costs, we have interest expenses. We have fixed costs like overhead, like salaries, whatever. We're writing checks. But here's an expense that we're allowed by the Internal Revenue Service, by our tax tables. We can depreciate $100,000 a year, or 10%. We're not writing any checks there, no money. But we're allowed to include it in our expenses because it reduces our tax liability. It's a tax deductible item. If we didn't have this 100,000 here, if I put 0 here, watch what happens to my net income. It goes up, but I'm paying a hell of a lot more taxes. So if I put that $100,000 back, I pay $30,000 less in tax. And why I do that is because then I add it back in down here because I didn't write a check. I get to deduct it, reduce my taxes, but then it's an additional cash flow item in this project. I actually made a profit of $205,000 because I made a cash profit of $205,000 because this is non-cash. So I'm adding it back. I'm adding it back. Just like we did here, salvage value. We're adding our gain on our disposal back in the 10th year. We're adding our depreciation back every year. All right? That's that. Now, it's 7 o'clock. I'm going to save this. Let's everybody save their work. And let's take a break. When we come back from break, we're going to finish up with this schedule and look at our return analysis work. I have a chat question before we go. Michelle has a question on depreciation. What is your question, Michelle?
Super quick. On the, I missed it, on the depreciation starting with year 1, I see 100,000 per year. But what was the formula?
No formula.
Oh, the depreciation. It's no formula. It's just a given.
Yeah.
It's just a given. Okay.
Now, if I was a real jerk, I could say they're using the straight line depreciation over the 10 years.
Mm-hmm.
Oh, straight line, straight line. Oh, okay. But I've decided not to be a jerk. I just give you the depreciation amount. I'll be a jerk.
I appreciate that.
I'll be a jerk about other things. So don't think I'm being a nice guy yet. But that I will always give you that input. Okay?
Thank you.
When we come back from break, we're going to finish out this spreadsheet and then figure out what the hell did we just do. All right? So let's save it, and I'll put on some music, and I'll see you back in about 10 minutes. Let's make it 7:02. Let's make it 7:15. I'll see you back at 7:15. Smoke them if you got them. See you at 7:15. Go.
Venez donc chez moi, je vous invite. Il y a de la joie chez moi, c'est merveilleux. À côté des étoiles, j'habite. À 2 pas du ciel toujours bleu. J'attendrai chez moi votre visite. Là-haut sous les toits, dans mon logis. Tous les jours je reçois. Venez, venez vite, c'est gentil chez moi. Venez-y.
Okay, we're back. A couple of questions while we're on break. Professor, I lost. Could you go over formula F? Oh, sorry, let's go back to the very beginning. Jesse, what formula did you use for the salvage disposal in 018? Well, the salvage disposal in 018 is taking the $50,000 disposal value and taking out the capital gains tax, the tax you have to pay as that's profit after you fully depreciated the asset. So I take, my tax rate is 30%. So if I take 30% of 50,000, that's $15,000. So I would net out after taxes $35,000. How I would do that in a formula would just take $50,000 times 1 minus the tax rate of 0.3 or 30%. That's 70% of 50,000, which is $35,000. So that's how I calculated the after-tax gain on the disposal value in year 10. Next question over the break. From Yvonne. Yvonne, really? I lost some of the formulas as I was TP. What does that mean? What's TP? Your toilet paper? What's that all about?
Keep going.
As I was typing into Excel, could you over, I should probably say go over.
Hover.
Oh, could you hover over F15? See, I don't speak the language of Burbank. Over F15. Okay, let's look at F15. F15, there it is, right there. That's the taxes. So notice in the formula, I take the earnings before taxes, F13, and I multiply it times 30%, 0.3. So I take F13, multiply it or times 0.3, and I get my tax of my earnings before taxes. And then I subtract that 45,000 from F13 and I get my net income. So I'm taking 30% of the earnings before taxes in every one of those lines. Yvonne, is that okay? I guess so. Next one from Michelle. Professor, my totals for year 2 are off slightly for the tax rate.
Two. Yeah, 2 and going forward. I'm off by $1,200. I missed I'm trying to logically do this in my mind. And I don't know where I'm missing.
That could be dangerous. No,
I know.
So do you have $158,000 as your earnings before tax in year 2?
No, 162.
Well, then something.
So, that's why.
Yes, because you
Yeah,
should have, you should have 204,000 in variable costs.
That's
50,000. So your variable costs, you have to take the number in year 1 and multiply it times 1.02. That's 2% inflation. Then you'll
I'm taking, okay.
Those formulas were already in the
F10.
cells.
Okay.
Those.
Yeah, I don't know.
So
right.
you take F10 times 1.02. See that?
Yeah.
F10 times 1.02.
I see. Yeah. I don't know. My formula's changed somehow. I don't know.
Sometimes we have the
That's
ghost.
one way to learn.
We have the ghost of accounting past that is always haunting us. The ghost of accounting past.
It's sabotage.
It is. It's a ghost. Okay, so you got it now?
Yes.
Very good. Let's go back to another chat. Let's hope Yvonne has no more questions. Let's see here. Okay, after the break. Okay, we're all set. Okay, Jesse, I didn't know if Jesse heard how I figured out salvage. Jesse, you still have a problem with that? I didn't know if you were back yet.
No, I'm good. Thank you. Appreciate it. Thank you.
Okay, good. All right. God, I got major dry mouth tonight. And I'm running out of iced tea. I'm in trouble. All right. Now, we've already added back in depreciation there. Now let's tackle working capital. Working capital as a percent of next year's sales, 12%. What the hell does that mean? Well, let's use our own personal financial affairs to this. If you go out tomorrow and go to the car dealership, which you probably won't be able to do tomorrow, but let's say this is the normal world, and you go to a car dealership and you pick out a brand new car. And that brand new car costs $50,000. So you have a down payment of $10,000 and you're going to borrow $40,000. So you arrange financing from your bank. You borrow the $40,000. Your interest rate on the car loan is 4%. That's your cost of capital. So now you're financing that car. You've borrowed $40,000. You put $10,000 of your own money. You now have invested $50,000 in your car. Is that the end of your investment in the car? Hell no. The rest of the investment is called working capital. Registration fees, maintenance, insurance, gasoline. Those are all additional expenses that you have to spend in order to drive the car. If you don't spend anything on registration, insurance, gasoline, maintenance, the car ain't running in California anyways. You can't drive a car in California without registration. A lot of people do. You can't drive a car in California without insurance. Many people do. And you certainly mechanically can't drive a car if you don't put gasoline or maintain it, oil. That's working capital. And many times you have to spend that working capital. You have to buy registration. You have to buy insurance before you operate the vehicle. before you get any return out of the investment. That's the premise behind this. I'm investing $1 million, but I'm going to need additional cash to get that investment up and going before I actually sell the product. I'm going to need upfront money. That's called working capital. And we have risk managers, we have purchasing agents, we have public accountants, we have internal auditors that calculate that calculate this information for us. And in the case of this example, it's determined by our risk managers or our public accountants that 12% of our yearly sales is going to be our working capital needs. So look what I do. In year 0, before I've sold anything, I'm taking 12% of my first year sales, and that's a negative $60,000. That's bringing up my total investment in the asset in year 0 of the purchase of the investment or the asset and the working capital needed to get it up and running. This working capital could be computer programming, maintenance, setting up the equipment, whatever. But we have to spend upfront money, and that's $60,000 based on an estimate provided us 12% of yearly sales. But our sales change every year because of inflation. Because of that increased sales, we're probably going to have increased inventory costs. We're going to have increased accounts receivable costs, whatever working capital, and we have to fund that every year. And notice what I'm doing. I'm taking 12% in this calculation in year 1 of the difference between year 2 and year 1 sales, which is $12,500. I'm taking 12% of the difference between year 2 and year 1. That's $1,500. In other words, at the end of year 1, I have allocated $61,500 of working capital, which just happens to be 12% of $512,500. So I do this every year, taking 12% of the delta or the change in sales. But notice what happens in year 10. It's no longer a negative number. It's a positive number, and a big possible number, $74,932. Why? Because the project now is financially at an end. Year 10 is the nada for the project. Fini, it's over. So all this working capital that I have allocated and allowed for over the 9 years, including year 0, now is going to be added back. Because why? I've been reimbursed those costs and that cash over time through these expenses. I've charged back on it. I've gotten my money back. And notice if I take year 0 to year 10, the total of that is 0. I now have added back, charged back, and now added back, and it's 0, my net working capital costs over the life of the project. How did I get this $74,000? I took 12% of the last year's sale, $624,431. 12% of that is $74,932, which just happens to total all these numbers here, $74,932. The net effect on the project is 0, but I'm properly allocating the cash by year as working capital, and then I get it all back at the end of its life. Whew. But let me tell you how important this is. When most companies plan on producing or investing in a new asset, they always make sure they have enough money for the investment, but they almost always forget, hey, we're going to need extra money for cash flow for working capital. to get the project going and starting. And that's why many reasons why businesses fail, because they don't have enough working capital. And just what's going on in the economy today. All you've been reading in the business sections for the last couple of days is, when is Congress going to allow for and pass an additional $484 billion for small business loans so they have liquidity and can pay for working capital. Now that money has been passed and the companies have their dough. But that was the sole reason why you try to keep small business operating, to give them the capital, the cash flow, so they can pay their bills until they get back on their feet again. That's called working capital investment. This is huge in our analysis. So we
Professor,
now have.
can I ask a question?
Sure.
This is James. I see that how the working capital for each year adds up to the right number. That makes sense.
It does make sense.
But if we're supposed to take 12% of working capital as of next year's sales, shouldn't you take the entire 12% every year?
No, working capital says working capital should be, and I don't include it here, I ran out of space. Working capital, if you read this in chapter 11, you would know.
Okay.
Working capital is a percentage of the next year's sales. So in other words, remember, working capital is an asset liability number. It's not a 1-year deal. So at the end of year 1, what do I have? 60,000 plus 1,500, that's 61,500. What's 61,500? It's 12% of this number.
Mm-hmm.
In the next year, it's now 63,038. That's 12% of this number. See how that works? It's always totaling to 12% of the next year's sales.
Okay. So it's not cumulative. It's like 1 year at a time. Okay, I got it.
Yeah, you don't want. See, you're overstating if you put $61,500 here, your percentage is like 25%.
Yeah.
You're not doing a proper analysis. You're overcharging.
Right.
Make sense?
Yes.
Chapter
Professor?
11. Yes.
Where did you get 12%? Was that just a number? Or is that going to be given to us, or do we have to figure that out?
Follow my cell here. There it is right there. It's always given to you. If you go on and get your doctorate degree in finance, you'll learn how to calculate that. Trust me, you don't want to do that. Okay, but that number will always be given to you. Okay, the key thing about this work is I'm going to give you all the inputs. You got to put them together. That's your job. I'll give you all. The only thing you have to calculate, and usually, I might give you that. You're going to have to calculate WACC. That's chapter 9, and that's what we did here. You might have to do that. But all the rest of the numbers will be given to you. Okay? So, what do we got? We know that we're spending $1,060,000 on this investment today. And we're generating in cash flow, net income plus depreciation minus working capital, and in year 10, adding in after-tax salvage value and adding back in working capital, we're producing on an investment of $1,060,000, we're creating 2.41705 in positive cash flow. Sounds like a pretty good investment, doesn't it? Sounds like a pretty good investment. So I'm now going to wipe out these numbers that were already given so I can show you the calculations. So now, what is this $2.4 million worth today? So we can compare it to the $1,060,000. And this is what's talked about on page 417 of your text, net present value. And here's the calculation. We want to take this cash flow from year 10, including every year, all the way back to today. with the discount rate being our cost of money, 8.83%. And it's called discounted cash flow. And here's the calculation. Ready? Formula, function, financial, net present value, NPV. There it is right there. NPV. Bring it up. We want to put in our interest rate, 8.83%. That's our cost of capital that we've already calculated. Under value, you paint from year 1 to year 10. F21 to O21. You're now saying, all right, formula, take that cash flow over the next 10 years and discount it back at 8.83%. And when you hit OK, you get this, $1,510,832. That's the discounted cash flow. That's the today's value of $2.4 million discounted back at our cost of money. So now we're comparing apples to apples. Our cost of our money today and the value of our future money today. And that's how you determine the net present value. The net present value is equal to the amount of the discounted cash flow plus the negative cash flow in year 0, $450,832. That's the difference between today's value of the cash flows less the investment. So we're making on this project in today's dollars, we're actually making $2.4 million. But in today's dollars, we're making $450,832. And that's a good thing. We know that the investment, if all these numbers pan out and are correct in our estimates, that's how much profit we'll be making when we discount that money back to today and compare it to our investment. That's 400, that's on page 417 of your text. So this is a return analysis in dollars. In dollars. The internal rate of return is a return analysis in percentage. And this is what this means. Formula, function, financials, IRR. There it is right there, internal rate of return. You hit OK, and you don't have to put in any interest rate. All you have to do under values is paint from year 0, not year 1, but year 0 through year 10. You include the investment as negative cash flow, and then it's comparing that to the positive cash flow out into the future. And you hit OK, and you will get 17.03%. That's how much we're returning in a percentage. We're making 17% on this investment in today's dollars. What does that mean? It means we're making a profit. Why? It's costing us 8.83% for the money. We're returning double that. That's why we have such a large dollar profit, $450,000. Return in dollars, return in percent. This is the NPV formula. This is the IRR formula in your calculations. And I'll explain why we're doing all these various different methods in just a minute. That's the internal rate of return analysis on page 419 of your textbook. Then it asks you to determine the profitability index. The profitability index is the relationship of the discounted cash flow to the investment. What's the ratio of money we're returning in today's dollars versus the investment? So in the formula, we just put in equals the discounted cash flow, which is E22, divided by negative E21. Why do we put negative? Because that number is in a negative number already, so we're going to turn it to a positive by doing that negative before the number, and we get 1.41. That's the relationship of return to cost in a ratio. This is a return analysis in a ratio. Okay.
Professor,
Yes, ma'am.
I'm sorry to interrupt, but you got 1.43.
Oh, all right. Sorry, my glasses are getting fogged up. I'm getting too excited by these numbers.
Well, I was kind of confused because I actually got 1.41.
So you took this number here, 1,510,632, and divided it by negative 1,060,000, and you got 1.41?
Yes.
How did you calculate this number here? Did you take the NPV of 8.83% times F21 and O21?
I think that's where I'm off a cell. Okay. Thank you.
Sure. As I'm going through this, try matching my numbers with your calculations, and if they don't work out, be like Michelle's. Say, Mr. Hassey, I'm not matching. Probably
Professor?
yes.
This is James. So my numbers are off based on, I think it's starting to be off at DCF. I'm wondering if, so my formula, I used the 8.83.
This
should I-
number, okay, yeah. Are
This
all
is
your
what-
are all your cash flow numbers correct? Do they total 2.417? Hello?
No, they don't.
So you got something wrong in your formulas here, right? You got to double check those.
Okay.
These numbers should match up here.
Okay.
When we were on break, you should have checked that out.
Okay.
Do you have 2035 and 1, 209063 and 2? Check those numbers out and check your formulas.
It's the salvage value. Okay.
Ah, there you
Figure it
go.
out. Okay.
All right. Just double
And
check
then-
your note.
Professor, can you hover over the MPV, the E23?
It's E22 plus E21.
Thank you.
Good. IRR, return in percent, profitability index, return in a ratio. And then finally, on page 430, we have the payback method, which is the return analysis in years, or let's call it time. How long before we return our investment? All right. Let's see how we calculate that. It's just arithmetic. How many years without discounting do we get back our $1,060,000? So right here, I will put a formula equals E21, which is the total of cash flow in year 0, plus the cash flow in year 1, F21. And you should get 856,500. After year 1, that's how much we still have left to pay off on the investment. Then in year 2, we take that balance after year 1, F27, and add in the year 2 cash flow, G22. And you should have $647,000. still have to pay off. And now that I have that formula set there, I can just take that corner and drag it all the way. And you should get 432,654, 211,987, and then in year 5, it's a positive cash flow of 14,230. You now have repaid the $1,060,000 after in year 5. So it's 1, 2, 3, 4 years plus, here's how you do this. You determine what percent is year 4's balance to the year 5 cash flow equals negative cell I-27 divided by cell J-22. You will get, let's get that dollar sign out of there. You will get 0.94. In other words, we were 94% through year 5 before we paid it off. 1, 2, 3, 4.94 years. That's the payback period. How long it takes us in dollars to recoup the $1,060,000 investment. We're not doing any discounting, just straight dollars. And that's our return analysis in years. We're making in today's dollars $450,832. Where that's transcribed into a 17.03% return. In a ratio, it's 1.43 to our investment. And we're paying it back in a little bit under 5 years.
Professor?
Yes.
I'm sorry. I think I zoned out just for a quick second. What's the 0.94 again, one last time?
What percent is our year 4 balance that we still have to pay back of the investment to the year 5 cash flow? It's 94% of that amount. 94% of 12 months is somewhere along the first or second week of December, I believe. So around the first or second week of December of year 5, you've paid it off. The remaining 14,730 is cash flow at a profit over and above the cost. 1, 2, 3, 4.94 years. And I got that 94 by taking the percentage of the year 4 balance to the year 5 cash flow. Make sure you save it after this, because now we can do the analysis. What does this tell us? Well, a lot depends on the culture of the company. Many companies, General Electric, University of Laverne, Disney, Cisco, every company in the world has set cultural guidelines to investment. In General Electric, they don't make an investment unless it has a 20% internal rate of return. In Apple Computer, they don't make an investment unless we recoup our cost and our investment in 3 years. In Ford Motor Company, they don't allow an investment unless it generates at least $1 million in NPV. In Cisco, they do not make an investment unless the profitability index is 2. Every company has their own parameters. Every company has their own guidelines. One of the questions, if I were Yvonne, and you know anybody in the finance area of Disney, is what are their internal return parameters? What do they stick by when they make an investment? Do they want to make a certain IRR? Do they want to have a payback in a certain amount of years? Do they want to have a certain amount of dollars they're getting? Or do they have a certain profitability ratio? Every company has these in their guidelines. So the strategy begins there. Let's say in this company, their barometer is we have to make $400,000. Let's say in this company, we have to have an internal rate of return of at least 15%. Let's say in this company, they have to have a profitability ratio of 1.25. And let's say in this company, they have to have a payback in 5 years. Well, the strategy is, hey, we're meeting all those guidelines. Let's go with it. Let's make the investment. Let's create the product. Let's put it into function. Let's sell it. Let's market it. Let's make the money. All right? The strategy is determined by what the numbers tell us vis-a-vis the culture of the company. For some companies, the NPV might be $500,000. The internal rate of return might be 18%. The profitability might be 1.5. And the payback might be 4 years. We're close, but we're not meeting it. Now this depends on the strategy of the company. We're close enough, let's go ahead and do it anyways. Or you might say, we're still not meeting our guidelines, find a way to make some more money. And here's what every American company has been doing for the last 30 years. Geez, if we build this product in San Dimas, California, we're making these numbers. How about we make the profit, or make this profit, or make this company, or make, let's figure it out, Mr. Hasse. Let's say we take this product and build it in China, where there's costs are lower, where there's no tax. Then we're going to make a lot more money. That's what Apple Computer did in 1998. We're not going to build Apple products in America anymore. Let's build them in China to get a greater return on our investment. That's what happened in the 1980s and 90s to American corporations. They found it cheaper to build automobiles in Mexico. They found it cheaper to build products in South America. They found it cheaper to import goods and services than build them ourselves in America, where the costs were greater. A perfect example of that is union membership in America. In 1970, there were 45 million Americans in a labor union. In 1990, there were 15 million. Whoops. Where did all those jobs go? They went to China. They went to South America. They went to Mexico. Because MBA students who became MBA managers said, hey guys, it's cheaper to make our cultural returns by building our product in another area of the world. Our costs are cheaper. We can build our tennis shoes for Nike in Vietnam at 2 cents a unit. In San Jose, it's costing us $10. Duh, let's build them in Vietnam. And that's what has happened. That's what MBA analysts have determined. And this has been a typical strategy of all corporations for the last 30 years in America. We find the places in the world where we can meet our profits at lower costs. And that's what's happening. But now, after all these years of doing this, I'm not going to get into any political commentary, but after all these years of building our products in China, after all these years of building our automobiles in Mexico, after all these years of importing tequila from Mexico instead of making it here in America, now you have a president and a feeling in America of nationalism. Hey, let's get back those jobs that these son of a guns took from us and build the products in America. And that's how Donald Trump got elected. Let's bring those jobs back here. And how has he started to do that? Tariffs, import duties, immigration laws. That's his strategy to keep our products and produced in America. And he's done that in low unemployment. And you know what, guys? I'm sorry to say this, some of you might cheer, but before March 12th, he was going to get reelected because he's been doing all those things. Unemployment was near zero. Companies were making huge profits. Everybody was working. He was going to get reelected, even though the guy is an emotionally unstable individual. The government and the economy was kicking butt. But then the coronavirus hit. He had no control over that. And now the economy is in a standstill. People are out of work. People are losing family members to viruses. The world has changed. You're listening to Mr. Hassey with this stupid Zoom stuff instead of listening to me in person in my handsome figure in Burbank. But the world has changed. So we have to adapt. We have to change. This is probably going to cause Joe Biden to become the next president of the United States because people say, Donald, I ain't working anymore. Why should I vote for you? Donald, I've lost my paycheck. Sorry, I ain't voting for you. So what's the response? This is my last political commentary. So what's the response that Donald Trump has? It's the Chinese fault. It wasn't my fault. It's the governor's fault. It wasn't my fault for viruses. It was somebody else's fault. Don't blame me. Keep reelecting me because I'm looking out for you. It was somebody else's fault. Welcome to our election of 2020. Joe Biden has to convince the American people that it was Donald Trump's fault and he needs to hit the highway. That's the bottom line for our election. Okay, that's my political commentary for the day. But it all evolves around money, return, where we're building the product. Where can we build an investment of $1 million to get us a profit of 17% return? Chat question. Probably somebody's going to yell at me about my political beliefs. Yes, Cuomo too, Michelle. You're exactly right. I'm thinking, you guys write this down. Write this down. You guys are going to laugh, but here's what's going to happen. Joe Biden and Michelle Obama. Michelle Obama, vice president candidate. Trump doesn't have a prayer. Will Michelle Obama do that? I highly doubt it. But that's the winning ticket. Trust me, go to the bank on that one. It's going to be tough for Donald Trump to beat up on Michelle. She has a solid reputation. Joe, he's an old fart. Yes, I agree. But with Michelle on the ticket, Joe can win. Cuomo, sorry guys, I'm from New York. Too many skeletons in Mr. Cuomo's closet. Trust me. Too many skeletons. And those will come out. Michelle, I agree with you. Michelle Obama says she doesn't want it. But when she knows she can do her service to America by kicking this pompous ass out of Washington, she might do it. I don't have any skeletons. What are you talking about? My closet is clean, Michelle. I have no skeletons. My only skeleton is I've been thwarted all my life by knowing about NPV, IRR, PI, and payback. That has been my downfall all of my life. It's made me socially non-functional. Okay, I'm getting off here on tangent. It's getting to be 8 o'clock.
Well,
and
let me draw you back into the.
Oh, here comes Yvonne. What's going on?
So what's interesting is that the formula that you had us calculate the DCF, right?
Yep.
Is actually the financial formula in Excel for NPV.
Exactly. It's called
Okay.
NPV because it's helping determine the net present value. It's the net present value of the cash flows. The answer net present value is the difference between the net present value of the cash flows, which I like to call discounted cash flow, and the investment. So you use the NPV calculator to determine the NPV. Fair enough? Yeah, sorry. That's a little bit puzzling, but it works. All right. Ladies and gentlemen, this is your template. Save it. Cherish it. Go to bed with it. Wake up with it. Live with it the next month. This will get you through the second half of the course. Trust me. I'm going to post this to that week number 5 in-class spreadsheet file folder after class. So you'll have the completed version. I'll keep the original file in there. I'll call this week 5 capital budgeting final review sheet. The answers. This is your template. I'm going to give you a problem next Friday where you can practice that problem using this as a template. Okay? And we're also going to talk about this next week. Here's what we're going to talk about next week. Just give you a preview of coming attractions. This will really get you excited. Notice over here in the left-hand side, we have this information added, risk analysis. One is called the scenario analysis. One is called the sensitivity analysis. This is the risk analysis associated with these numbers. Here's the thinking. What if these numbers are wrong? What if these numbers are wrong? What if the analysis is bogus, BS, not right? What if we screwed up? This analysis over here will tell us that. The scenario on page 471 to page 474 of your textbook, and the risk sensitivity analysis of 468 to pages 470 of your textbook. These analyses we are going to do next week. You are also going to do these risk analysis in your capital budgeting paper, and you're also going to doing these analysis in your case number 3. We will work on these next week, okay? Might want to take a gander at those, and you'll say, and now you'll really be bringing out the Canadian Club whiskey after you see this stuff. But again, I will walk you through it next week, no problem. So this is chapters 10 and 11. It's a capital budget analysis to determine the investment in an asset, calculating the cash flow that that investment will produce, and then comparing it in 4 different analyses to the investment. Return in dollars, NPV. Return in percentages, IRR. Return in ratio, profitability index. And return in years or time, payback. Some of this should be old hat for some of you, but don't worry about if it isn't, because I just did this where you now have a template and now have a recording of this analysis. And again, we're going to go through all this again next week. We're spending 2 weeks on this sucker to help you because it's that important. I'm now going to our next topic. Does anybody have any questions about this analysis we just did?
Professor?
Hi, Alice.
Hi, how's it going?
Not bad. I'm a little bit lightheaded. I'm a little bit lightheaded after this analysis, but I'll get through it. Go ahead.
So I guess my question is in general, it's like NPV, IRR, PI, payback. What if you encounter in one of the case scenario that you only fit 3 criteria and then one of them didn't meet?
Yeah.
So does company usually invest on that, or is just based on a judgment call?
Again, it depends on the people making the decisions. You know this, Alice. You work in companies. You work in companies. Some people have egos. Really? That's surprising. Some managers and decision makers have egos. If this is their pet project, but it's still showing maybe negative numbers, they might go ahead with it anyways because they got an ego. I can make this work. Let's do it. In other companies, they have strict guidelines. And they say, if it doesn't meet all 4 of these, make it work. And then you just go back to the drawing board, Alice. You try to cut costs. You maybe try to cut costs. You find different vendors. You find cheaper money. Whatever. You go back to the drawing board. And that's what the usual procedure is to make that work.
Okay.
Okay? Good question.
Thank you.
Good question. Anything else? Now, I know a lot of you, your head spinning and going, what the help? All right, it's okay. Come back to this later. This is just the beginning. We're going to be doing this over and over in the next couple of weeks. No worries. All right, I'm going to save this. Now I'm going to go to something else. Darlene Zamora, you never show yourself. I'm hurt. Angel, you should show yourself. I'm hurt. Roman, you never show yourself. I'm hurt. All I see from James is St. Petersburg, Florida, but at least I see James. From Yvonne, there's Darlene, very nice. From Yvonne, I see not very much interior decoration in her house. What's going on there?
I'm sitting in our spare bedroom. It's a futon, and
I'm teasing you. You should say, Mr. Hassey, shut up. It's none of your business.
it's nobody's business, right? But I do
Exactly.
have Donald. That's my favorite Disney character, so he's here with me. So there you go.
Very nice, very nice. And Roman, good to see you. Here's a chat from Angel. I have to use my laptop to use the camera, and the larger monitor is much better. A poor excuse, but we'll accept it. Thank you, Angel. That's very nice. I'm just teasing you. Roman, good to see you. You know, Roman, you're a good-looking guy. You got to show your face to us. You're a good-looking guy. All right.
Appreciate that. Thank you.
Okay. Now to bring up another lovely topic. Let me bring this up here. Oops, wrong one. Where is it? I got to get it. Bear with me, guys. It's in another file. Excuse me. Okay. You have some casework this week. And here is that case. It's already posted in the Blackboard. You already should see it on your Blackboard. This case is doing some work in regards to financial analysis, but you're putting it into a PowerPoint format. PowerPoint. Mr. Hassey, I've never used PowerPoint in my life. Well, this is what graduate school is all about. Now you have to do it, all right? It doesn't have to be fancy. It can be very basic, but I want you to answer these questions and create slides in a PowerPoint format. This work is due next Tuesday at 9 o'clock, all right? Here's the work, and then I'll show you some examples. The first question, strategic quantitative financial analysis. Just the title scares me. Last year, Swenson Corporation had sales of $303,225, operating costs of $267,500, year-end assets of $195,000. The debt to asset ratio of this company is 27%. So what if you have $195,000 in assets? Now you know how much debt they have with a debt to asset ratio of 27%. The interest rate on this debt is 8.2% interest. And the firm's tax rate is 37%. Now this is where you're going to earn your money. The new CFO of this company, Swenson, wants to see how the return on equity would have been affected if the term had a 45% debt ratio. Assume that the sales and total assets would not change and that the interest rate and tax rate would remain constant. How much would the return on equity change in response to the change in the capital structure? So you have to recreate from this information the net income of the company at a debt to asset ratio of 27% and the net income of the company at a debt to asset ratio of 45%. Why? Because that debt number will drive your interest expense, which will drive your profit after tax. So you're going to have to determine that. And then to determine the return on equity, you have the net income. Remember, the definition of return on equity is net income divided by the equity position of the company. Well, you know the equity position of the company. If you know that the assets are 195,000, the debt to assets are 27%, the equity must be 73%. And here, 55%. I want to see how the return on equities changes with the different levels of capital structure. Sit on that for a while. Welcome to MBA life. Question number 2. Using the company that you had in case number 1, question 4. So for Jesse, that's Home Depot. For Angel, it's Nike. For Roman, it's American Express. For James, it's 3M. For Yvonne, it's Microsoft. For Michelle, it's Johnson & Johnson. For Thomas, it's Boeing. For Alice, it's Walmart. For Darlene, it's Coca-Cola. Using that company, perform a financial analysis using the data from the most recent fiscal year. Now, for some of you, that might be 12/31/19. For others of you, it might be another time. But whatever the most recent completed fiscal year, perform a financial analysis and compare those numbers to the previous fiscal year. So you're going to do 2 years. And you're going to use 5 numbers that you will select. You will pick them. 5 numbers from the sections of financial analysis given in chapter 3 on page 119. So you're going to pick 1 liquidity number, 1 asset management number, 1 debt management number, 1 profitability number, and 1 market value number, and use the data from the most recent fiscal year for your company and the previous fiscal year, and then put them side by side and answer these 3 questions in your interpretation on that data. Has the firm improved its performance from the previous year? Is the firm managed efficiently, bad choice of words there. And as a potential investor, would you consider this a stock you would purchase? So based on your analysis of those 5 determinants, answer those 3 questions as a summary of your review.
Hey, Professor Hasse, I have a small request. I don't know if it's too much of trouble to ask you for this, but any way you can make the assignment due by midnight instead of 9 p.m.?
I can even make it due Monday or Wednesday at noon if you want me to.
It's up to you, but at midnight Tuesday is fine with me. That's okay.
I know you bat people out there need to where you're at your best in the late evening. No problem. We'll make it at midnight. It'll be changed.
Thank you.
And again, remember I told you guys this last week, James and anybody, remember, if you don't have enough time, you can just send me an email. Jesse could say, Mr. Hasse, it's 9 o'clock on Sunday night and I'm pulling my hair out. I'm not done in time. Can I post this on Wednesday night? Can I post this even on Thursday or Friday of next week after our next class? I don't have a problem with that. I want you to do this right, not become a basket case by meeting deadlines. Because I know all of you have responsibilities with your job, with your families. Your working situations are different. I got that in the interpretations you guys wrote about last week. So if you need extra time, take it. Just let me know. Fair enough? But if I were you, I would do 1 problem a day if you have the time to do this and not wait till Sunday, Monday, and do it all in one sitting. That's an awful lot of work to do. Okay? That's only me commenting.
Professor Hasse?
Yes.
I'm sorry to interrupt. So the PowerPoint will be for both questions.
There'll be 1 PowerPoint for all 3 questions.
All 3 questions. Okay. And we have until Tuesday at midnight.
Yes. Or you can take longer.
Okay.
Okay. Here's question 3, the last one. You already did this calculation last week. Weighted average cost of capital. Firms raise capital at the total corporate level by retaining earnings and obtaining funds in the capital markets, stock or debt. Then they provide funds to their different divisions for investment in capital projects, like the $1 million investment we did tonight. The divisions may vary in risk. One division of Disney, the theme parks, might have a different risk than ESPN, or so on. Therefore, it is conceptually correct to use different risk-adjusted cost of capital for the different capital budgeting projects. Use the cost of capital calculations for your company from question number 2 that you did already. Remember question number 2, you did the cost of capital calculations here. Whoops, where is it? Oh, where did I do that? Excuse me, the cost of capital calculations from question 4 last week, cost of equity, all right? And then I'm sorry guys, I just realized I made a mistake. There's one piece of this that I haven't posted. I'm gonna change this. I'm gonna give you, you already determined the cost of equity last week in question 2 of your data, right? Now in question 1 of this week, in question 2 of this week, I'm going to give you the cost of data, not so much as an analysis of this question, but I'm going to give you what their cost of debt is, all right? Their cost of debt. You're going to use that cost of debt in this problem down here to determine the WACC of your company, all right? Sorry about that. I messed up on my posting, but I'll fix this. In other words, you're going to determine the cost of capital for your individual company, okay? In other words, you're going to go to your company on December 31st. What is the percentage of debt and equity? That's your capital structure. Then you're going to use the cost of equity here that you've calculated in question, case number 1, question 4. Then I'm going to give you the cost of debt for your company with their tax rate. I'll give that to you. Then you're going to calculate the weighted average cost of capital for your company. And then you're going to make sure how you would relate to that to this question here. Okay? You're going to determine the WACC of your company from you selected last week. You're going to do the financial analysis here, and then you're going to clean up and finish up the WACC calculation, and I'm going to give you, I'm going to list each company, Home Depot, Nike. That's something that I left out when I posted. Remember I said last week I will give you that data? So I'm going to give you the cost of capital, the cost of debt, and the tax rate for each one of your companies. You're going to apply that to the capital structure that you're going to determine and determine the WACC for your individual companies. Okay? And I'll fix that up tonight and clean it up and put it into Blackboard this evening. So you're going to be doing a PowerPoint presentation with these 3 questions as answered on the slides. Now, if you go to your Blackboard site tonight, let me bring that up. Sorry about making that mistake on the case, but I'll fix that immediately after class. My error. Here's our Blackboard site. If you go to case study, there's a little bits of information there that will help you. First of all, there's a rubric. There's a rubric that shows you how I'll be grading it. Then there's a sample PowerPoint from a prior class, a totally different subject, but I'll show you that PowerPoint in just a minute. It gives you a sample of how you should set this up. And then here, I explain to you why we're doing this. All right? I explain to you. The goal of case study in our course is to assess the student's ability to research data, interpret the data, and present these interpretations in a format that communicates strategy or outcomes. To present information analysis in formats that help the student practice various platforms of presentation skills: APA writing, PowerPoint, spreadsheet, online discussion. This case number 2 is the PowerPoint platform, designed for the student to research financial data, interpret the data, and present it in specific bullet point analysis and interpretation. The PowerPoint has a 15-slide maximum. No more than 15 slides for the 3 questions combined. It's 15% of your course grade. Now here's an example of a PowerPoint from a prior class. And that's, I give you that example as a file in the case study file folder. Here it is right here. It's a PowerPoint presentation. Again, you're not presenting it, but you're putting together like you're presenting your interpretation of those 3 questions. So you have an opening slide. You can format it any way you want. You can be very technical, or you can just do the basics. The name of the case, all right? Your student name, the class, the time period. And then each slide should be used to interpret the question. All right, now again, this case is a totally different subject matter, but notice I have various PowerPoints, various numbers that highlight my answer. I even put in little graphics. Maybe a picture of your company's logo would be kind of clever. You can incorporate analysis like charts and just paste them into your slides, or Excel file slides into your slide. As sophisticated as you want, but as basic as you want. Each slide has a different format for their answers, or you can use the same format, but you just be specific. I don't want a bunch of BS text. I want the questions answered in a PowerPoint format, bullets. Here are the answers. Here's my interpretation. Boom, boom, boom. Not draw. I don't want pages. Notice there's no pages of text here. It's bullet point answers of the problems. That's important in a presentation. You're not writing something, you're presenting it in a format. Here's an example of the cost of debt calculation. This might help you in this problem. Here's an example of the cost of equity calculation. And then you conclude with references. Where did you get your financial data? Where did you find this data for your financial numbers? You list the references that you used. Notice this presentation is 14 slides. The maximum is 15 slides with an intro, answers to each question, and a final slide of your references. That's what I'm looking for. And that example is in your PowerPoint slides. Now I know you guys are going, Jesus, what the hell am I doing here? Guys, let me give you one word. And I don't want to sound like a snob here, but you want to get your money out of this course? This is a GRADUATE class. This is a graduate class. When you have an MBA degree, people are going to pay you 200,000 juju beads a year because you know how to do this stuff. Because you know how to present data. You know how to research data. You know how to interpret data. If you want to get value out of this course, you got to know how to do this stuff. Trust me. If you want to just go walk through the motions and just kind of go through it and do a, excuse my French ladies, a half-assed job, go ahead. But remember, when you're out in the job market, companies are going to ask you, hey, can you show me a presentation you did while you were in graduate school? Can you show me an example of a paper you did as a capital budget analysis in graduate school? Can you show me some of your work from graduate school? You show them this file? Damn, right on. This is how you get value out of your education. It's time to do that. If you haven't done this in other classes, shame on the professor. But I'm going to make you do all these analysis. This one is PowerPoint. Next week, it's going to be a APA file for APA paper format. The week after, case number 3 is going to be all spreadsheet. You're going to put this information and then research in a format that tells somebody, I know what the hell I'm doing. And that's important. Don't like me, I don't care. But in 10 years, you'll thank your lucky stars that you did this stuff. Trust me. Trust me. Even though you don't trust me on this one. I hired MBA students for 25 years. I know what good MBA students could do in the workspace, knowing what they did and studied in graduate school. Trust me, I know. Okay, so let's bring up the rubric for this. Remember, if I'm in my Blackboard, darn it, too many files open. If I'm in my Blackboard, here it comes. Here's my case study number 2 file folder. There's the case there in PDF and Word doc format. Here's the sample PowerPoint that we just saw that you can download. And you can even use that sample as your template. I don't care. I really don't. I don't. And here's the rubric. And this is what the rubric looks like. It shows you what I'm looking for to get your grade. Here are the grading scales. Excellent, good, acceptable, poor. Hit the highway. None of you will do that. You guys are all going to get this level, trust me. I'm going to take 33% of your grade on your use of data and data research. Where did you get the information? Is the information you gathered right and correct? 33% of your grade. 33% or a third of your grade is what that data tells you and associated with the case. Question number 1, what's the change in ROE between 27% debt and 45% debt? Question 2, what does the financial analysis of comparing year to year tell you about the company? Efficiency, performance. And in question 3, how does the company's weighted average cost of capital tell you about the companies in their cost of capital related to maybe different divisions within their company? Each one of your companies you have listed have different divisions. How will the WACC be affected by, let's say you use the Nike Jordan line compared to the Nike Tiger Woods line? What is the risk between the 2 lines and how would that be incorporated in the weighted average cost of capital? And finally, 34 or another third of the case is your presentation, your format, and your use of the PowerPoint slides. How you present the work is a third. So data, 1/3, interpretation, analysis, 1/3, format, presentation. Does it look clean? Does it look professional? Does it look like, when you get done, does this look like what you would expect an MBA candidate be able to put together? All right? That's the format. And when I grade this work, I will give this sheet back to each and every one of you. It'll list your name and your grade and how I determined your grade with some comments below. This is the grading sheet for the work when you're completed. All right. Boy, did we cover the topics tonight. All right. I know you guys are a little shell shocked, but now's the time. Week 5, I start putting the pedal to the metal. Now we see what you guys can do as regards to data analysis and research and interpretation and how you present it to moi, not to anybody else, to me. And then next week, you have a case, a capital budgeting case, where you'll do that in a paper format. Then in 2 weeks, in case number 3, you do it in a spreadsheet format. And here's the kicker. In case number 4, the last case, you're going to be doing it in a video. A video format. Putting together a video of your interpretation and analysis of something. You don't have to go out and hire a cameraman or a camera woman or do makeup or anything. You can be just as goofy looking as I am on TV. But in case number 4, you're going to be doing that in a video that you're going to post to Blackboard or YouTube, whatever you see fit, and I'm going to review that video. You don't have to show it to any of your colleagues. It's not going to be shown to anybody. It's just a video of an interpretation to me. And it only has to be like 5 or 10 minutes. It's not a big deal. Different varieties of presentations to hone your skills of being a manager. How many times have you been in meetings where you're on a teleconference and somebody's running a meeting? That's video. How many times have you been in a meeting where the presenter is doing a PowerPoint presentation to interpret and show you the skill, show you what's going on? How many times have you been in a meeting where a spreadsheet is used to get ideas across? You are now going to do those in the remaining 5 weeks of this class. And you know what? You're going to love it. You're going to like it. Because the bottom line is that when you get out into the mean, cruel world of modern America, and you have to compete for jobs within your own company now, or you have to compete for jobs in the marketplace, you'll have the training and the skills to say, you know what, I can do this. This is no problem. I got it. That's important. And the best thing about it here is I'm here every Wednesday, every Friday afternoon, every weekend. If you need help, you can come online with me and I will be there to help you. I will guide you through it. Not to sound mushy, but I will hold your hand and lead you to the promised land. The promised land is what? Not only an A or a B in this course, but the confidence that you will know that you can do this. That's huge. That's huge. And that's how you get value out of this class. Confidence. I can do this. I can do this. And that's important. So, in summary, what have we done tonight? Well, Mr. Hasse, you've given me an ulcer tonight. Thank you for giving me an ulcer. I appreciate that. So Friday, yes, Michelle, from 1 to 3 o'clock, you just log into that Zoom link, and I sit there in front of the computer and just stare at it and wait for your calls. Yvonne has done this before. Yvonne, did that work out okay? Yeah, so it works out fine. Also, if you guys can't do Friday afternoon, let's say Jesse works Friday afternoon, all right? Jesse could send me an email or a text message and say, Mr. Hasse, are you available Saturday at 1 o'clock? Mr. Hasse, are you available at 10 o'clock on Sunday? I'm going to church to pray for myself so I can do this, and then after church, I'm going to see you, Mr. Hasse. All right? So I can be available whatever your schedule is. I can even meet James in St. Petersburg if it's so desired. So if you need to talk to me this weekend, no problem. Not only just Friday, we can do any other days. I have nothing else to do. I can't play golf. I can't cut the grass. I can't go swimming. I can't do anything. I might as well sit here and talk finance. Boy, is my life ruined. How about that? All right. So what we've done tonight is we've looked at a capital budget analysis. The template is done. This is going to lead us into more discussions next week. And we looked at case number 2. Case number 2 is a case where you're going to answer 3 different types of interpreting financial information. a given financial data that I give you in question 1, the financial data from your company, and the capital budget or weighted average cost analysis of your company in question 3. All calculating and then interpreting what the data tells you. That's case number 2. And you just don't have until midnight on Sunday. You can post this later. Just don't make it too much later. Now, don't wait till like Friday or Saturday of next week to post it. That gives you 2 weeks to do it, or a week and a half. Set Wednesday as a maximum date. But again, I'll work with you. You tell me what your situation is. It's no problem. It will mean no difference to your grade. I just want you to do it correctly and get something out of the exercise. So Yvonne, you can use Donald Duck. Darlene, you can use anybody you want. Roman, as long as your hat is on straight instead of this way, you can do anything you want. Wear it like
Get a haircut these days.
I know. My hair is, I'm going to have to start wearing a hat pretty soon. My hair is getting a little shaggy myself. Jesse wears the hat properly. See, Jesse, he's got it properly on his head. Very nice. He's in law enforcement. He knows what's going on. All right. Enough of this nonsense. It was good seeing you tonight. I think we had a rather full class. Do the best you can. Start on case 2. I'm going to post a problem on Friday as practice of the capital budgeting case we did tonight. We're going to lead into that into next week. Again, Friday office hours from 1 to 3 or at your convenience over the weekend. I know this is a lot, but every week's going to be like this from here on out. Trust me, right? It's going to be this involved. Somebody has a question. Don't be mad at me. This is good study. So Friday, just log in. Oh, wait. Michelle has a migraine. Come on, Michelle. You don't have a migraine. You can do this. Michelle, piece of cake. See what I'm doing here? I reach over. Here's a glass of Jack Daniels. I toast. I can do the problem. No problem. All right. Anything else, guys? James, smile. It's not that bad. There you go. Darlene, you haven't smiled much tonight. I don't know what the problem is, but you got to tell me what's going on. All right. Isn't this fun, Darlene? I'm telling you, I won't be able to get to bed till 2 a.m. in this morning. I'm going to be so wound up from this class. It's getting me going. I need help. Okay. Thanks, everybody. Probably see some of you this Friday or this weekend. Don't worry about it. We'll get through this. Do the best you can. And remember, you're creating value for yourself. This is the most important thing. See you guys. Have a good evening. Adios.
All right, thank you. Good night.
I've recorded
Bye.
this. I recorded this, by the
Thank
way,
you.
so it's recorded. Take care.
Bye.
Yvonne. Bye, Michelle.
Bye.
Bye, Alice.
Bye.
Bye.
Bye, Michelle.
Oh.
Yes.